Hello everyone, I'm Chad Broberg, Partner and Wealth Advisor at Landmark Wealth Management Group. I'm going to kick off this investment market review of the first quarter. Today, I'm joined again by Kathy Jensen, who is a wealth advisor, and Ryan Trabant and Dennis Sturz from our investment team. We got some good feedback on this format last time, so we're going to try it again this quarter. Kathy, let me start with you. What's on your mind these days?
Hi everyone. I always think it's helpful to start a conversation like this by reviewing what the major markets did in Q1. So Ryan, do you want to start there?
Sure. We had a really strong quarter in equities with some encouraging signs which we'll talk about. It was a little tougher for bonds as we started the quarter with rates lower than they are today, causing some of that bullish sentiment for bonds to disappear. Here is a chart that shows returns by major asset class. U.S. equities, as measured by the S&P 500, did well at 10.56%. Other sectors like international and small caps kept pace. Even value stocks performed better after lagging most sectors in 2023. International markets did do well with the MSCI ACWI returning 8.14%, and even emerging markets were better as China stepped up their efforts to stimulate their economy.
I feel like I've said this before on previous videos, but the U.S. economy continues to be resilient. The momentum factor was important in Q1. Stocks that have recently done well continued to do well in the first quarter. So trading strategies that follow trends did well. One thing we follow is a momentum ETF, and that momentum ETF increased by about 19.5% in the first quarter, compared to the S&P 500, which was up about 10.5%. This momentum ETF has the usual suspects, the large cap technology shares, but it also has weightings in companies that have been doing well, like Eli Lilly, Costco, GE. So we'll continue to watch that momentum factor.
Bonds have not done well so far this year. So what can you tell us about what's going on there?
Going back to the market overview slide, you can see that fixed income returns were negative in the first quarter. Treasuries performed the worst as the 10-year Treasury rate rose by 32 basis points. Credit spreads tightened further, and high yield held in pretty well.
What does all of that mean for the Fed interest rate decisions?
Well, we all heard on our last video that the Federal Reserve was predicting 2 or 3 interest rate cuts, while the market was predicting closer to 6 interest rate cuts. As time has gone on, those optimistic projections have started to fade, and interest rate cuts have really been pushed back a couple of months.
Well, let's change course here a little bit. I like to drill into the equity market a little bit. It seems like there's some competing views out there. So what expectations should we have made for the rest of the year?
Maybe we can argue the bull and bear case a little bit. Which one of you wants to take the bull case?
Well, I'll let Dennis take the bear case because that's not as fun. But I'll share with you what I think is going to drive the equity markets higher. First, we've talked about the influence of the Mag 7 stocks that they've had on the S&P 500, and many of those names have continued to do well so far this year. But one thing that I think is encouraging is that the rally is starting to broaden out. We've seen small cap stocks and value stocks perform well in the last 2 months, despite the fact that interest rates have increased a little bit over that time.
What do you watch to know if the market is broadening?
Well, there are a lot of things that different market analysts can look at. One of the things that we track is how small cap stocks are doing compared to the S&P 500. Since October 31st of 2023, small caps have actually outperformed the S&P. That's a good thing to see because you really can tell that the stocks are broadening out. You can see that also when value stocks start to outperform, or equal weighted index compared to a market cap weighted index.
Are there other factors that make you more optimistic about stocks?
Earnings for the fourth quarter came in better than expected, so that caused investors to be more optimistic about future earnings. Corporate stock buyback announcements have been increasing, so that usually helps support stocks, and it conveys confidence from CEOs about where the business is going. We only recently made a new high in the market, recovering all of the ground that we lost since 2022. So some would argue that the bull market is just starting and it's in its early stages. Lastly, there is approximately $6 trillion in money market funds, which is a record. Those funds have grown as yields of 5% or more attracted a lot of investment. If the Fed does start to ease, there's a lot of money that could come into the equity markets.
Well, that all sounds great. So what should we be worried about? Or what are the more bearish investors talking about?
One thing I worry about is when markets get too complacent, it sets us up for a setback. There are a lot of ways you can see or measure complacency. In the first quarter, volatility measures have been low compared to history. Volatility has jumped in recent days due to the conflict in the Middle East, but overall, volatility has been very subdued. Volatility in interest rates has also been low after reaching record highs last year. Normally, you would see some back and forth in equity markets, but until this past week or two, the largest pullback we saw was only about 2%, which is pretty unusual. Ryan mentioned earlier the expectation that the Fed will start easing this year. So even though the aggressiveness of that easing has been pared back recently, there's still an expectation that we'll see interest rate cuts. So if that doesn't happen, the market could have a setback. You see complacency in credit spreads with very low expectations of any issues from borrowers, as there's a lot of confidence and optimism in markets right now.
Do you think the market expectations are too optimistic?
Yes, it's very possible. One thing we try to pay attention to are valuations. So valuation measures on the S&P 500 at the end of first quarter were getting pretty stretched. So the PE ratio on the S&P 500 was about 21 times, which is at least one standard deviation above the historical averages. Other fundamental measures like price to sales or revenue-based metrics show similar things. If you think about risk factors, these have been pushed to the background as investors have worried about missing out on the rally. Last fall, we talked about growing deficits, and that came to the forefront for a while, but it quickly disappeared. This issue has not gone away. With higher interest rates, interest on the federal debt will exceed $1 trillion a year after being only $300 million or so several years ago. From a contrarian point of view, bullish sentiment has gotten to very high levels, so that's often a precursor to a market pullback. We've had a growing conflict in the Middle East, which could be a catalyst for a bigger correction. Finally, there's been so much attention and focus on AI, which has been driving large cap tech shares higher. We're certainly at the beginning of this AI revolution, but we really don't know how all of this is going to roll out, what new stocks might emerge, and what sectors might benefit most, and what regulations might come into play. If we don't see productivity improvements or profit growth from all of this, there could be some disappointment.
Are there risk factors or indicators that you are particularly focused on?
Well, we'll continue to watch earnings results and how the future earnings expectations are impacted. We really need to see earnings grow into the current valuation. We'll also be watching that momentum and those measures to see if there are any early warning signals that the market rally is losing steam.
I'll also add, we have to watch what news comes out of the election process. We have to be prepared for surprises and watch what the key election issues are that emerge. There is plenty of historical studies that show that the election outcome doesn't matter too much for the markets, but we are in some strange times.
Well, it seems like there's a lot of issues on both sides of the bulls and bears market. So what do we do with all that information?
Well, as you know, we have an investment committee process, which we've had in place for a couple of years now, and that is where some of this debate on these issues happen, and we decide as a group what we should do with our portfolios. It's not just one person making a decision in isolation.
That's right. There are a lot of issues on both sides, and it really makes it difficult to take an aggressive view either way. So we believe that you stay invested, you stay diversified, and you stay on track with your long-term strategy and objectives.
Well, that sounds like a good place to end this conversation. So thank you for being here, and thank you, Kathy. And thank you, our Landmark clients, for tuning in today. Take care.